Hi, I'm glad you're here watching this video of me working problem E10-16 from page 571. So now we're going to do equity investments. So equity investments means you're purchasing shares in some other organizations. Still an asset, but now you actually are an owner in the company. With bonds, you had just borrowed money. So in this problem, Boston Today Publishers purchases some stock in another company called Lovable. And so shares, that's the shares of stock. So they purchased 2,500 and the price is $24 per share. We're not too worried about this intention to sell. We're going to classify all our assets as just equity investments and not worry about adjusting the fair market values. All right, so this has no fair market value adjustments. We're not taking that into consideration in this class. But so basically we need to get this on the books, right? So we have to first of all acknowledge this new asset that we paid out some cash for. So we're going to have an equity investment. And of course, we don't have that cash anymore. We paid it out, but how much? Well, we know we bought 2,500 shares, and we know we paid $24 per share. So I've written down here, cost is price per share times number of shares. So $24 times 2,500 equals a cost of $60,000. All right, so that's our equity investment, $60,000. All right, so what happens next? Well, the next thing that happens is we receive a cash dividend of $1.50 per share. So sometimes companies will pay out dividends, and so that means you're going to get some dividend revenue in, and comes in the form of cash. So that's pretty cool. We're going to get cash, and of course we have some revenue, right? Dividend revenue, because it came in. Don't just write dividends, because dividends are what we would pay out, right? Because we're a company too, so we might pay out dividends, as we'll learn in a future chapter. So we get cash in and we get dividend revenue. How much? Well, they just told us on a per share basis. So total dividends are the dividend per share, which is $1.50, times the number of shares, which we know is 2,500. So $1.50 times 2,500 is $37.50. Right? So there's my cash. And there's my dividend revenue, $37.50. Now, the next thing that happens is we sell it. So we purchase. So just like with bonds, you can purchase, you can sell stocks, and you might in between receive with bonds interest, with dividend, with stocks you might get dividends. We're not worried about this adjustment. We're not doing that in this class. Sold the Lovable stock for $18.20 per share. Well, that's less than what we paid for it, right? So we're taking a loss, all right? So we're going to get some cash, right, because we did sell it. It won't be as much as we paid out, but we'll get some cash. We'll take a loss on disposal. And then, of course, we'll no longer have this investment, so we got to take it off the books. All right, so how much? Well, obviously, cash is what we get per share. So we are getting $18.20 times our 2,500. $18.20 times 2,500 is $45.5. Right, so we get 45,500 in. We no longer have this equity investment. It was 60,000. take it off the books for that. And so this difference, obviously, we've got to make our debits equal our credits. So the loss is equal to 60,000 minus 45,500, which is equal to 14,500. All right. So in this case, we purchased an asset. So we increased the asset, decreased the cash, got some revenues. We sold it, so we got cash back, but not as much as we paid for it. So when we have to take a loss, and of course the loss is just the difference between what we received for it and what we paid for it. In the next video, we will do a gain on disposal, and then that will pretty much be all your choices for doing stocks.